Welcome back to Focus Fridays, new week. I'm still Jared Shum, Head of Investor Relations here at Focus Capital, and I'm joined again by our VP of Investments, Chad Olson.
Good to be here.
Chad, last episode we walked through due diligence, the process of validating a deal before you close. Today we're going to go one level deeper into deal structure itself, one of the most important concepts in real estate investing and the one that directly determines your risk return and priority at exit is the capital stack. So understanding where you sit in a deal's capital structure, in my opinion, isn't really an optional thing. It's pretty foundational. So again, we like to start out pretty broad. What is a capital stack? Let's define it, and what does it represent?
The capital stack is the combination of equity and debt, and you're splitting it between those two sides, whether that's investor capital that makes up equity or an individual's cash position, also equity, and then debt provided through leverage from either various institutions, whether that be bank, life co, or a debt fund, or if you create your own loan against yourself, and even seller financing would be considered debt, and that can make up that side of the equation, assets and liabilities, or equity and liabilities, and that equity can be made up of a few things, just like the debt can be made up of a few things.
Yeah, and I think traditionally there's usually three layers to a stack, and if we just were to use the right nomenclature there, it's like senior debt, mezz debt or preferred equity, and then common equity. And each layer has different terms traditionally, which means different risk and different expected returns. So if we went through the stack from bottom to top, starting with senior debt, could you and that's stuff that you deal with, on a day-to-day basis when it comes with a first mortgage, typically provided by a bank or an agency lender. Can you go into a little bit about what senior debt kind of looks like on a capital stack?
Yeah. Like you said, it's bank, Fannie, Freddie, HUD for the agency side of things, life cos, debt funds, and then, like I said, the optional seller financing or notes of some kind, hard money lending, that kind of dances with a debt fund to a degree. Each one of those sit in a various place on what your optionality is, on what they're willing to take on in levels of risk, but then they're going to be compensated for that level of risk, generally speaking. So your agency and your HUD are going to be your tightest on interest rates. That does not necessarily mean that they will be the best on proceeds, which is the loan amount that you're going to be given at the closing table. It all depends on the current in-place operations of the property. That's where those things are the best. And so they're better on a refinance situation or an acquisition of a good deal that's performing pretty well, that you might see some other optionality to get to in reflection of the purchase price. You're going to be capped at getting, 70 to 75%, generally speaking, LTV on whatever that purchase price is with no other fees. And so when you factor in fees and CapEx and these other things that go into most of the deals that we look at, that starts to get down. And so your leverage could be closer to 55 to 60% by the all said and done.
Yeah.
And that starts to have a bigger impact on investor returns overall, or on your cash on cash, or any of those return metrics that we're focused on. As you go through the rest of those options, bank kind of sits above that, a little bit higher interest rate, but they'll play with you and play ball with the proceeds, giving you additional funds for the CapEx needs to renovate and upkeep a property or deferred maintenance that's left over. They'll future fund that with you and alongside of you and give you that percentage, meet you where it is, but that rate is going to have a higher spread, usually quite considerably over whatever the agency is currently going for. And then you go to the next tier. Life cos can straddle that depending on a lot of factors. They can sit in between banks and agencies, but usually on a very large, typically on a larger size of loan proceeds that they would be giving. That's where they get competitive. Otherwise, they sit really alongside banks on the smaller ones. And then debt funds sit above that. Usually very prohibitive rates in the grand context, but they will give you 80, 85% leverage on the current in-place deal and what the capital expenditures you want to commit to the property, and then want to balance out to 70, 75% cost or what you think the appraised value is going to be. The whole plan on that is to go to that permanent agency debt at a later date and time using those vehicles. They also, each one of those things comes with very like different setups, and they are all negotiable in a lot of ways. But with agency, typically it's fixed rate financing. They do have a floating rate option, but typically you're going to lock in at a fixed rate that's pegged to the treasury underlying the term that you're going on. With debt funds and banks, they typically start variable rate, and then you can lock them in through various vehicles, whether that be interest rate swaps and caps and things like that.
Yeah. And before we move on to the rest of the stack, it's important for people that aren't really familiar with what a capital stack might be. When something is at the bottom of the stack, it means that it gets paid first in all scenarios. So if the property is ever sold or liquidated, the senior lender is made whole before anyone else sees a dollar. And for the borrower, senior debt typically covers, like you were saying, anywhere from 55 to maybe upwards of 75% of total capitalization. And then the next level, mezz debt, mezzanine debt, and preferred equity occupy the middle of the stack, and they take on more risk than senior debt. But in exchange, they get high returns. And we've talked about, what me and the other chat have talked about, on when you make investment, your compensation should be directly correlated with the risk that you're taking on.
Yep.
Can we talk a little bit about how preferred equity pays out in that, what that looks like, what the difference is between this tranche versus kind of the senior debt tranche and stack?
Yeah, expected outcome is what it is. But yeah, mezzanine, they both very much loosely dance with the transition between debt and equity, right? And so mezzanine, I think, does typically get connoted with being a debt tranche more so than it gets contributed to being an equity tranche. Mm-hmm. It sits, like you said, on top of the senior note. There usually has to be negotiations with that lender. Some don't, some do, but agencies very much particularly, and that goes with pref too, preferred equity, that, they need to know that the other one exists. But that mezz and that preferred equity tranche, as we work our way through it, they act very similar, I would say that in a lot of ways they're kind of the same name, or same product, but different names on either side. But it all really comes down to the structure and where it sits, where preferred equity doesn't really have any entitlement or perceived entitlement to the underlying asset in a real way, where mezz kind of does lean that way. You can record that second position, you can do some of those, and that goes into also tying into like B notes, as you're saying with the senior load, or that'd be an A note, then you have a B note. So they have a lot of different names in the industry to be covering that stuff. But with mezz layer, it can be structured so many different ways, but overall, you're still going to look at your overall rate that you end up with. That's going to sit even higher than the debt funds that I was talking about. You're going to see 8, 9, 10% rates, if not higher. Mm-hmm. Same thing with pref. With pref, preferred equity, so we can kind of drive that thing differently because it goes into the LP return stuff too. But with a preferred equity tranche that you're just sitting there in that layer and you're coming in on a deal and investing a certain amount of that capital stack, you're sitting above that senior note or that mezz, but let's just push the mezz to the side right now. But if you're putting in that preferred equity layer, then the debt's going to get paid, then that preferred equity is going to get paid, right? Typically, what they're going to try to get out to is 10 to maybe even 15% IRR over the course of whatever that investment period is, 3, 5, 7 years. But they're only going to make you current pay, which is going to act much like the senior note does. Mm-hmm. We only want to get 4, 5, 6, 7%, whatever that number is, during our period. So every month, every quarter, every year, they're going to get that rate of rate paid back to them. Kind of as an interest only is the best way to look at it. And that's going to come right out of the cash flows of the property. The remainder is going to accrue that by the time the end of the investment comes, then they have to be caught up, and all of that has to get paid up to that 10 or 12, whatever that defined IRR hurdle that they wanted to hit. So all this property sells, obviously the senior note gets paid off, then the preferred equity tranche, all the accrual and whatever's remaining to hit that number. The remaining cash from sale will go to the LP equity that we're getting to next year.
Yeah, and I think that when going into the LP equity side of things, something that is really important for LPs and limited partner investors is that these instruments in the mezz debt and preferred equity side of things are used when the senior loan really doesn't cover the full capital need, and the sponsor, the operator, us, the GP, doesn't want to dilute common equity any further. And so that's kind of the main tool that that to understand where those notes are coming from. And then there's common equity, which is a little bit of a misnomer, but it sits at the top of the capital stack and absorbs the most risk. So it's the last to be paid in any distribution or liquidation scenario, but it also captures the most upside. And that's why I say that common equity is a little bit of a misnomer, because it does capture the most upside, and it has most appreciation, profit at sale, the full benefit of operational improvement. And in a syndication like ours, LP investors typically hold common equity positions alongside of a GP. Here's a term that some investors may have heard, but most operators have heard is first loss or first loss position. And that's used pretty frequently in our industry, but is not something that is super clear. So what does first loss mean, and why does that matter?
First loss is just the position to lose your money in that position as you go back down that capital stack. If the property and asset isn't performing, if you have these various other structures in that capital stack, there you got priority. And I mean, even with that, what people don't talk about, it's like you got to pay your taxes. If you're not paying your taxes on that property underlying it, you have an issue there, because they actually have even position before the senior lender, right? Which is why the senior lender typically escrows everything and pays the taxes on your behalf to protect their interest in that asset. But it works its way back up the capital stack. So it's just your risk, like you kind of laid out, I think, well. In that top stack, that LP equity, that common equity, you are taking on the most risk in buying that asset. And in the event that the property is not cash flowing or doesn't sell for what you think it's going to sell for, your returns are going to be the ones that are compressed first. That senior lender, and like we talked about in the previous podcast, that senior lender, that bank position, is your biggest partner and your biggest investor in the deals that you're going to acquire. But they made sure to stay at that 60 to 70% mark to give themselves protection on whether asset values move up or down.
Yeah. And with that, I think it's important that we talked about, that to be compensated, you should be directly compensated for risk. Those should be directly correlated. But understanding your position in the stack can also help with your expectations, because senior debt might return 6 to 8% with very little risk. Pref/mezz might target, I would say, between 10 to 14% with moderate risk, and then common equity with well execution and a value add deal might be between 15 and 20%. But obviously at a much higher risk, but that return is neither guaranteed or fixed.
And I would say that that's my struggle with the preferred equity space now. It has a place, for sure has a place, and it's done well. But I mean, you are taking on essentially the same amount of risk as those equity holders, right? Like if you get tiered up in that, you got to really watch how that preferred equity is coming in. The ones that are executing really well are coming into distress situations where the leverage is pretty light to begin with. They're meeting in with the pref. They're taking up most of that they're getting kind of rid of the common equity. They're coming in there, and still, even with values being depressed, they're still in it for 80, 90% of where they think the values actually are. That's where preferred equity, I think, has a place for investors. But if you're coming in and you're just there to help leverage up a deal or miss an equity gap, then you're taking on the same risk as any LP would come into that deal. Sure, on paper, you have a better position, but if the deal isn't performing, the deal isn't performing. It's not going to make up for a thing, but you are not getting compensated for that potential upside like an LP investor would be in that same thing, taking on that level of risk. And that's where it kind of comes down to the expectations of where you think this is going to turn out.
Yeah, I would say that in that given example, like a preferred equity position offering 8% is a very different proposition than a common equity position offering like 18%. Like those risk profiles are not comparable at that point. And then when it comes to how does the capital stack affect what passive investors receive? For our LPs, that they're all in the common equity position. So just like most syndications, they participate in cash flow distributions when there are distributions, preferred returns if the deal includes them, and then profit at exit. So with waterfall structure, which we covered in a prior episode, that governs exactly how those distributions are calculated and sequenced. And I think what's most important to understand about common equity distributions, that they're subordinate to debt service. So if the property isn't generating enough enough cash flow to cover the mortgage, LP distributions could stop. And with some of our properties, they when we do cash flow reserves and amortization and stuff like that, it could just delay when they start instead of having to stop. And this is why debt coverage ratios and conservative leverage are so important, because they protect the equity layer's ability to receive distributions even in periods that might be a little bit more operationally stressful. What should investors ask about capital stack when evaluating a deal? So if someone's reviewing an offering, what are the right questions to ask about that structure?
It depends on where you're coming in at. You know, you want to start with the loan and the lender. You want to understand how far into the process they are, who they're going with. Have they done business with this individual or this entity before, right? And then the answer doesn't have to be yes, that they have. If it's their first time doing agency, there's a little bit more risk and execution on that. If it's their first time working with a new bank, there's potentially risk in that. We've had instances where banks have retraded us on what they originally promised. Sometimes it's a little bit more expected than others, but the instances that we mostly dealt with are not. And it was more of an investment committee decision that then got reflected on us. So you want to know how far baked in the process that they are approved or not approved, and then what the terms of that loan agreement look like. Because I've heard some stories out there of people signing up with different operators, and they find out later that that operator took on variable rate debt when they otherwise probably wouldn't have signed on to a deal like that, because the person, it can change, right? Like you might, and that's why you kind of ask some of those vetting questions. If you have someone that's going in there and, and they're saying, we're going to go to agency, it's my first time doing it. You want to understand, okay, do you have the ability to guarantee the loan? Because there's certain parameters that are not waiverable. You have to have a certain amount of net worth. You have to have a certain amount of cash. You have all these things. And, in this business, there are people all over the spectrum between people that are very well capitalized and people that are not and just getting going. Both sides of it are good operators, but they also are in different situations. So if you go into and say, hey, this is my first agency deal, okay, are there going to be other guarantors in there? Do you have those people ready to go? What do their deal look like? Because they could be taking up a lot more of the GP percentage. You just need to understand all those deals. And that also tells you whether the execution is going to happen, because they could be showing you a deck that says we're going to get this pretty high percentage in proceeds and pretty really favorable interest rate. And then you need to vet out whether that thing's actually realistic, because they could say that, and then a month into it, they find out that that underwriting that they got from whatever loan broker they went through is not going to execute that way, and they're going to miss it by a lot. That might incentivize them to then go out to find a very different loan structure that they otherwise weren't trying to figure out. So you want to understand that loan relationship and how their execution has gone. Look at their previous deals, as always, and just try to ask some of those probing questions to know that. The next thing is mezz or pref being used in these deals? And what do those look like? What do those terms look like? Where do I sit in this capital stack is, kind of the first question. It's like the first answer is going to be, yeah, LP equity, but what else is in the middle of that? And just what are those terms? Because you have to understand, to your point about the debt's going to get paid first, you want to keep reasonable leverage on the deal. And you, as an investor, want kind of to push that leverage as much that is reasonable. And a 1.2 DSCR, which is where most things are sized, 120 to 130 DSCR, debt service coverage ratio, that's pretty healthy for any kind of deal. And so if the deal is sizing to 75% leverage with a 1.2 or 1.25, you should feel pretty good about that and want that leverage because it enhances your returns.
I would say that also, like, the nice thing is, we're in June now. We started raising last month in May for this deal that we're closing our capital raise on. And when I am presenting to new investors and even some of the current investors, our decks show what our capital stack looks like, how much leverage and what type of leverage bank loan that we're bringing on, and then how much we're actually raising for. So the common equity side of things. There will always be a GP committal. We do 5+%, like on this last deal, and that's in our deck. So it's not even something that you should need to ask. It's in our assets, and it's easy for us to go through that, not just from an academic exercise, but it also helps people determine, what risk that they're taking on and how they're proportionally compensated for that. the last thing that I would probably ask and interject there is something that maybe some investors won't ask, but what is the LTV ratio or loan to value ratio, and how much equity cushion exists before the debt is impaired? And that's because in previous roles, at previous companies and stuff like that I've been a part of, is people can say that they're conservative all the time, but you don't see where that conservation is. Like everyone will say that, oh, we're conservative underwriters. Like we've thought of all these things, but to hit certain returns and to make it something worth it from an operational perspective, there's got to be certain margins that you're going to hit. So
yeah, the easiest one. I mean, the LTV question first. What was
like how much equity cushion exists before the debt is impaired?
Well, the whole thing. But what the metric that you want to get focused in on, and it's the easiest one to look over, and it's the most impactful, but break-even occupancy. And you're looking at mostly economic occupancy. That's taking the GPR numbers, the gross potential rent numbers that are coming from the rent roll, and then factoring out vacancy, concessions, loss to lease, and bad debt, breaking that number down. And that's the number you want to focus on as your stress test about whether you can cover that debt service to a reasonable amount. And if that break-even occupancy is 90%, that is not a margin of safety deal whatsoever. And then, 80%, you want to be 85 and under, I think, is where I like to see a healthy break-even occupancy and stuff, unless there's a really good story about why that is. Kind of goes into leveraging up a deal. You might go in and buy a deal with that bank debt or one of these other things. The operations of the property does not support a loan amount that you're about to get given, right? It's the plan and the operational execution that you're bringing on, the capital expenditures that you're bringing on to improve the property, then saying that, okay, after this capital is spent, this deal will now be worth X, and we're going to loan to that number is what the bank or the debt fund is effectively doing. And so that DSCR is calculated, but the property at current is encumbered a higher amount than what it would normally be. So it is stressed coming into that situation. So if that year one, that economic break-even occupancy number is a little bit, is tighter, but year 2 or 3, that becomes more of a question of the confidence in the operator and their execution. Because, hey, here's the plan. We know we're bringing on a little bit more leverage, but it's in support of us to execute a different business plan and move this property forward, and then bring in higher rents, bring in higher income, and thus you're increasing your returns and your cash on cash. That's why that's going to happen. But that's the number to really look at on the long term once you get to stabilization 2 and 3. But all that being said, the conservative thing, you can say that you can make that look pretty decent if your rent growth is really strong, stronger than it probably should be or comfortable, and a few other factors that you can kind of manipulate to make that number look not so bad. But if things don't go right, it's actually way tighter than what you would normally think. So you've got to stress test a few factors in there.
Yeah. And like, if investors take anything away from this episode, it's like understand the framework of a capital stack, so that way when you evaluate deals at a fundamentally higher level than those that focus only on projected returns, you're really able to evaluate your risk and how you're compensated for that. Chad's going to be joining us again in a future episode where we're going to be building directly on this. We're going to walk through how to read a pro forma, so what the key line items mean, how the capital stack we discussed today shows up in the numbers, and if you've ever looked into a real estate investment summary and felt like you're missing context, that is going to be the episode for you. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.